Bitcoin, Wyckoff, and the psychology of the market. So I have something a little bit different for you today. I wanted to take a look at something that I found very interesting on the internet about Bitcoin and the Wyckoff distribution and the psychology of the markets. And a lot of people are trying to determine and understand which direction Bitcoin is going. As we speak right now, we're at 36.16. It is 12 p.m. Eastern Standard Time. I am on the East Coast of the United States. So Bitcoin's been dancing around in this area, trying to get back above 36, 37,000. It's been bumping 35, 36 in that range, a little bit, a couple little dips down into the 34,000 range. But I've found some pretty interesting information here that I wanted to go over with you. And quick look at the markets, the altcoins up and down every day. One day they're green, one day they're red. Really interesting how this is kind of working. They're bouncing back and forth. And of course, as Bitcoin is down, the altcoins are down with it. If Bitcoin goes up a little bit, the altcoins kind of follow it. And also we have seen the action based on what the Fed said the other day with the markets kind of selling off a little bit. There is expectations we're going to see even more sell off in the market in the coming week, which is going to affect Bitcoin, as most of the markets are very correlated now with the institutional action in the markets. So here's something, when you talk about psychology of the markets and expecting what to expect, and you've heard all the sayings, this is the shorts, the Bitcoin shorts. This popped up the other day. A lot of people were taken off guard by the amount of shorts that came into the market the other day. And if you look at this, the last time we saw something close to this was during the initial dip of May 16th, 17th, 18th, 19th, and 20th. And when you look at the chart, that kind of brings you back to May 16th. It was after the initial drop. May 16th, 17th, 18th, 19th, and May 19th was the first bottom before we bounced a little bit and then dropped down to the low that we've seen at 34,000. We had a wick down that day, May 19th, of 29.9, that $30,000, $29,000 wick that we had on the 19th. So that was represented right here during this time frame. So we've had this big spike in the shorts here, a lot of people taking short positions. So obviously that would indicate that a lot of people are expecting the market to drop. And then what's the saying in the markets? That whatever you expect, you're generally going to get the opposite reaction. So if this is indicative of a consensus that there is going to be short-term downside pressure on the price, that would mean that you should expect the market to go up, right? Because the market is going to do the opposite of what you think. Well, with the institutional investors in the market right now, they know everybody's looking at this, and they know that people are going to look at this and say, well, if everybody's shorting the market, then that means the market's probably going to go up and not go down. So there is an awareness of what's happening there. And when you think about Sun Tzu in The Art of War, a lot of great sayings, the enemy of my enemy is my friend, and all kinds of great Sun Tzu quotes. Great book if you haven't read it, The Art of War. But here's one on expectations and getting what you expect. Engage people with what they expect. It is what they are able to discern and confirms their projections. It settles them into predictable patterns of response, occupying their minds while you wait for the extraordinary moment, that which they cannot anticipate. Everybody's anticipating a short squeeze and for the market to go long. That's what everybody's anticipating. So what would Sun Tzu say? Expect what you are not expecting to happen. So that means that there is a good likelihood that we could continue to see some downside and that these short positions will prevail, which is kind of what we're seeing here this weekend. You know, yesterday, Friday, and going into the weekend, we don't know what Sunday is going to hold. We don't know what next week is going to hold. So I thought that was kind of interesting. And again, if you haven't read Sun Tzu, Art of War, you should definitely read that. It's required reading for the military. A lot of the military academies, a lot of companies, very great book on strategy, and a lot of great quotes came out of that book. So Here's the other thing that I wanted to show you that I came across was the Wyckoff. So there's been a lot of talk about Wyckoff method, Wyckoff distribution. Are we, had the distributive top, we dropped down, and now we're in this accumulation phase where people are trying to discern, are we in redistribution where we're going to see another downside? Are we in accumulation where we're going to see that bounce? When you look at the Wyckoff chart here, in the phases of the Wyckoff, we had that initial drop. We've been kind of bouncing around. We have the resistance, we have the support. So we have this accumulation bottom, and the expectation, again, going back to Sun Tzu, the expectation is during this reaccumulation phase, we're going to have that bounce to the upside. So that's what a lot of people are expecting right now. And this Wyckoff distribution is interesting. So Wyckoff was a profound observer of the markets. He aimed to explain the phases in the markets with a set of simple rules that anyone can follow. Despite his work being over a century old, many consider Wyckoff's methods to be one of the main pillars of technical chart analysis. And technical analysis, remember, and I'm not a technical analyst. I don't do technical analysis. I follow the analysis of others. I find the best in the business, and I kind of watch what they do, and I make my own decisions based on that. I'm a macro investor. I follow the market cycles, and I invest in trends within those overall market cycles, and I look for movements in the price action within those trends to make, in and out moves, bottom, top, that kind of thing. So I'm more of a swing trader, I guess you could say. I'm not a day trader. I don't do technical analysis. I play around with the charts, and I enjoy looking for patterns. I like to look at, again, I look at overall, if you go back to the chart, overall market cycles, which right now, the market cycle of a bull market, I like to do my swing trading in with these moves within the market cycle and kind of spot the trends and the patterns within that. So we're in a pattern right now. There's a pattern here, 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 and here. So let's go back to Wyckoff. So Wyckoff created the composite man. So instead of trying to understand the markets as an aggregate group of decisions, as most analysts do, Wyckoff did something entirely different. His idea was of the composite man. Think of composite man as an evil manipulator. Big narrative out there right now about the evil banks that are manipulating the market, which all markets are manipulated. So it's a natural course of the business, and it's not against the law. It's not illegal unless it's insider trading. Cryptocurrency markets are unregulated. Bitcoin is not regulated. So all bets are off there in terms of what can be done to manipulate the market until we get some regulation. It's going to be very difficult to avoid that. And the stock markets are manipulated. The mainstream media, CNBC, Bloomberg, Yahoo Finance, people go there, they talk their books up, they talk their books down. Bill Ackman went on CNBC right before the March pandemic and spooked everybody and created one of the biggest short positions and made, I don't know, $1 billion or $2 billion on that short position by going on, talking up all this panic in the market. He cashed in on it. So very controversial, interesting, but market manipulation has been happening for a long time in a lot of ways. So anyways, think of composite man as an evil manipulator sitting behind the scenes, controlling markets by pulling levers and pushing buttons. His goal is to perpetually outwit you and move the markets to your disadvantage. Here are some of Wyckoff's principal ideas of composite man. Composite man plans, executes his deception well in advance. Composite man is there to fool you to buying positions that he has already accumulated. Composite man will tempt you to sell at the worst possible time. Composite man rarely behaves the same way twice. Composite man leaves subtle evidence of his strategy for those who understand him. In other words, composite man is continually seeking to maximize his profit at your expense. So Wyckoff's accumulation distribution cycle. So everybody's kind of seen this lately that's following the markets and Wyckoff, and you can look this up. By the way, this article is 4xop.com/Wyckoff analysis. 4xop Wyckoff analysis. So you can kind of Google that and look that up. I'll show you this one more time. 4xop.com/strategy/Wyckoff-analysis. I just came across this kind of looking at some Wyckoff stuff. in terms of trying to find some information here. So anyways, it's a great article. So it kind of goes through the Wyckoff rules and things like that, and the price action and the strategy of Wyckoff, and how you can kind of use it the different phases of the market. And again, Wyckoff, a lot of this is principles that are used in terms of the, how the Wyckoff distribution works. And the big question right now, so everybody's kind of showing you this, and the consensus out there seems to be from a lot of the analysts on YouTube that you're seeing is that we're in this reaccumulation phase, and we're going to spring off, and we're going to head right back into the bull market phase again. And one of the things that I saw that was very interesting, that they show as an example, is this Wyckoff gold. Let me move this box here down to the bottom. Is this Wyckoff gold. So this is an actual example of the gold market from 2009 bottom going into 2010 all the way through to 2021 where we are today. And gold just sold off the other day. So the reason that they're showing this, and then I bring this up, is Bitcoin is now put in the same class as gold. So all of the institutions are coming out and saying that Bitcoin is an investable asset. It's not a currency. It is an asset. The Fed has labeled it that way, and they did that for a very specific targeted reason. The institutions are calling it an asset for the same reason, excuse me. And that's what it is. Bitcoin is digital gold. And that's basically where its place in the investment world is being carved out. So you can look at it in terms of the way it's going to behave. If it's digital gold, then it's going to behave from a price action standpoint a lot like gold. And gold is volatile, but not as volatile necessarily as Bitcoin has been, because again, it was largely retail driven until recently when the institutions started getting involved in trading it. But if you look at this, 2009, 10, same kind of situation as 2000, 19, 20 timeframe, especially after that March of 2020 downtrend that we had, sell-off that we had, everything sold off, and then the bounce straight up from there. Well, what happened in 08, 09, or I mean 2009 and 10? Well, we had the great financial crisis of 08, 09, and then the Fed stepped in and started QE, and off to the races. All the liquidity was pumped into the market, and we were off to the races, and gold was one of the beneficiaries of that. If you look at the stock market, same thing, off to the races. And then we've had a few hiccups along the way. Around 2013, 2014, gold started paring down a little bit, and then it kind of bounced around. But look at these phases in the market right now in terms of, and in relation to where we could potentially be right now. And you see the rules and principles of the Wyckoff. Price action is determined by supply and demand. Everybody knows that. Use, cause, and effect to identify accumulation and distribution phases. Risk on versus risk off, cause and effect. What is the Fed doing? The Fed has been pushing liquidity into risk assets, and now the trade is going to be risk off with inflation and interest rates rising, quantitative easing kicking in. Effort versus result can signal trend reversal. The Wyckoff strategy for the long side identifies significant trading ranges that have high probability of being accumulation phases. So if you look at that in relation to the gold chart that we just looked at, and we kind of run alongside here, the accumulation happened long before this uptrend. And after the initial distributive top, where gold hit the peak, it was sold off along the top, and we dropped down into that accumulation range. Notice how long this accumulation range lasts. And this is only about $1,000 swing in gold, few $100 swing, $1,000. So gold's only swinging a few $100 to $1,000 in this accumulation range. And if you see from a downtrending market that had that initial bounce, and then it's downtrending there, it's still kind of an accumulation range. And then it bounces up a little bit, sells off, bounces up, sells off, before it ultimately is back off to the races when it hits that final spring, and then we're off to the races back to another all-time high in gold. And this process from the initial bottom, the initial selling climax, 2013 timeframe, I don't know what the month is, it wasn't until 2019, so 1, 2, 3, 4, 5 years before we were back off to the races to an all-time high in 2021. So from 2013 and a half until 2021, so that's basically 8 years to get back to an all-time high from that initial selling climax coming off of an initial all-time high in gold. And you can kind of look at this top here and follow these things right along with it, where you have that distributive top when you're looking at gold. So you can see that the price of gold, let me get this out of here. Go down to the bottom there, may disappear for a minute. So you can kind of see, let me pull this over here. We'll kind of walk this along with the gold chart. All right, here we go. So you can see that the price is forming a long distribution top between late 2011, 2013. The point of support is reached in 2013. Point of support right there is reached in 2013. And this triggers a very small rally off the lows. A few weeks later, the market reaches selling climax. This steep fall triggers a much more substantial automatic rally that takes the price up to form a first line of resistance. So we're going to go right there, takes the price up to form that first line of resistance right there after the automatic recovery. And yeah. So yeah, up again, the first line of resistance, then gold trades sideways for much of the next 5 years as predicted by the Wyckoff system. So that's kind of that phase that we could potentially be in right now. And it traded sideways for the next 5 years. And one of the best things for Bitcoin right now, ultimately, is for it to trade sideways for a while. Because if it shoots, if it just automatically shoots up, it could go down to massive, massive lows. If it shoots down to massive, massive lows, then it may take it a while to get back up. So the best thing for Bitcoin as an asset is to trade sideways for a little bit and then work its way back up again and not have a significant sell-off or not have a significant immediate bounce. And I think a lot of people are used to Bitcoin making massive moves, and we'll take a look at that in a minute very quickly. And with institutions involved now, it's going to move a little bit slower unless there is some sort of a systemic issue within the system or the network that happens, some sort of an event that happens, something that nobody sees coming, nobody knows is out there. And if we get a huge accident in the markets, that could drastically affect the value of pretty much all the assets across the board. So everything would be in trouble at that point. So anyways, now we get into phase B, and phase B is going to contain another little bit of a drawdown followed by a recovery where the rally price is held back again by the upper resistance lines. And the lowest price occurs in late phase B. So the bottom of the bull market cycle after the distributive top that drops down is midway through phase B. After about a year and a half of trading sideways with a little bit of a downtrend, that's when you hit your bottom in 2016. And so then you get into phase C. So during phase C, the price remains between the upper support line, the lower resistance line, and only during phase D does the price break above the lower resistance line. It traces back to the lowest point of supply, which represents the last point of support, lowest point of support, and finally breaking through the upper resistance in phase D and E. This begins the backup phase where the price enters into the parabolic rally. So accumulation and distribution patterns, a significant accumulation and distribution periods occur over periods of months or even years, as is the case with gold. Notice that gold forms a single bottom cup and handle formation. Other patterns are common, including, here's your single bottom. Where did it go here? Your single bottom cup and handle formation. There's your bottom right there. There's another one here. Another one here as this thing just kind of bottoms out. But some of the other patterns are double bottom cup and handle, descending channel, ascending and descending wedges, rounded tops and bottoms. All of these are valid Wyckoff patterns. The basic structure of accumulation bottom will usually occur very similar. The important point is to identify the start of the phase B and from that determine the whereabouts of the lower support, upper resistance that forms the trading range. So The key is to identify phase B, which is kind of where we're at now with Bitcoin. We're going to look at this compared to Bitcoin and, kind of try to determine where in the cycle we could possibly be when it comes to Wyckoff. So let's take a look at that. So that's an interesting article, neat to read and kind of look at it and go through it like I did when you stack it right next to gold, just to kind of see how it looks. So now let's take a look at this next to Bitcoin. And if you look at Bitcoin from that point heading up, we had this first little sell-off right here when we reached about 40,000, and then back up to a high point, back up to a high point. And now we're in this phase B area, potentially. Could be a phase B area where we're just going to run sideways for a while and then ultimately move back up if this is in fact a bottom. Now we could very well be in this phase B range or phase A range. I mean, there is a potential that we could still be in phase A where we bounced here, kind of like what we're seeing right in this little area. This could be an accumulation here before we bounce up and go down to a lower leg. So if you look at this phase A, this could potentially, this area here could potentially be this area right here. That's a possibility. So we can't discount that. And then we could be looking for a lower range down where we accumulate sideways, but we could very much. And I mean, this almost looks identical right here, which is, it's uncanny how these charts look. And again, this is gold. This is digital gold, right? So we've come from the top, we've hit this, we bounced around phase A, then we drop down into phase B. So we could very well be in this phase B, which ultimately is a good thing. Although I know it's not what a lot of people want to hear, because it's going to take a while in this phase before we recover. And if we look at phase B and how it works, we still have some downside according to phase B, because we're kind of in this area of support range and bouncing around. We're still in a downtrend overall until we get to that bottom and you get that cup and handle bottom situation going on. We haven't reached anything like that yet. Not saying you have to have a cup and handle, but they're saying from a Wyckoff perspective, that's kind of indicative of a bottoming. So I think we may still have some downward action before we find that bottom. A lot of people seem to think that's 20,000 based on the last previous high of the bull market cycle. Could very well be. And then maybe you bounce off from there, come down a little bit to try to test it. You get some support, you're bouncing up and down, and a little bit of a range until you're back off to the races again. So just something that's really interesting to take a look at and how it relates to Bitcoin. The other thing that's really interesting to see and to compare these charts with is the psychology of the markets. So let's take a look at gold in relation to the Wall Street psychology of the markets cheat sheet and take a look at that. So you have this euphoric top, you have a little bit of a drawdown where you have some complacency, phase A, and then you start selling off into anxiety, denial, and panic. And that's kind of where you roll down into that phase A, getting into phase B. And phase B is where you're rolling along the bottom there, where people are just kind of in the anger phase, depression, and then, it starts to bounce up again and there's disbelief, everybody thinking it's a sucker rally, a sucker's rally. And these little phases here of the gold Wyckoff distribution and where we are in the Wall Street cheat sheet psychology of the markets, complacency, we just need to cool off for the next rally, anxiety, somewhere in this area before you get to phase B. Why am I getting margin calls? The dip is taking longer than expected. Denial, my investments are with great companies, they will come back. So, Bitcoin's always going to come back, never sell, let's sit here and hold. So that's kind of that denial. Panic, everybody's selling. You get that next leg down, which we haven't really gotten there yet. According to the Wyckoff distribution, we haven't found a bottom. If you look at the gold chart, we still need a little bit more room. And that's kind of where we were in that March 2020 situation with the pandemic. A lot of people thought Bitcoin was going down to $1,000 and it ultimately bounced. The Fed jumped in, provided liquidity, and everybody was off to the races. Kind of what happened here in 2009-10. And as you can see, same thing happened here. There's your March sell-off, boom, off to the races in gold. So really interesting. I just wanted to bring you that because ultimately it's funny. I did video the other day, and I asked the audience how many people were bullish, how many were bearish, and 70% of the people were still bullish. 30% were a little bearish right now, but they said ultimately bullish in the long run, bearish in the short time frame. So what's going on is a lot more people are understanding the markets and the psychology of it. Again, we talked about this range being a fantastic range of liquidity for institutions. They would much rather stay in this range because they can make more money than if we get back to 100,000. So if they're in this range in 30,000 plus or minus 30 to 40,000, if that's our bottom and that's the low range of Bitcoin, there's not a whole lot of upside for institutions getting to 100,000 because it's not going to happen overnight. It's going to take time to get there. So they're going to be able to make more money getting in and out with, these 20 to 30% moves daily, weekly, in this area here. And, we're not having that big of a move on a daily basis, but over a weekly basis, that's a pretty big move. So if they're generating 20 or 30% a week, I mean, that's 100% return in a month. And they're not going to be able to get 100% return in the next couple of years, generally with a bull market. So there's a lot more incentive for institutions and for more sophisticated investors to want to stay in this range than to go from here off to the races. So, and as we saw with gold, when you have an asset that is a store of value, it's a more longer term time frame to get to the end result. And as you can see, we have the dreaded death cross that's crossing up now. And remember, these are just moving averages. All this is doing is just kind of showing you where the average prices are. It's just a trend line of average prices. You can go back in the history of Bitcoin. You can look at the pi cycle tops I showed you the other day. You can look at where these death crosses happen. And it's again, it's a lagging indicator of price action that's already occurred. Then the real question is, well, what happens after that? So you can see a death cross right here. We already had price action occur to the point of the death cross. And at that point, we had a little bit more of a sell-off. We had a bounce, and this is what a lot of people are saying. A lot of people are telling you, hey, where we had a death cross, it bounces and goes to the upside. Well, after it does that and comes to the upside for a while, we had a little bit more of a sideways trend, and then it bounced up, dropped, and then we were off to the races. And again, I think that March 2020 anomaly, I think we would have been off to the races here, which is really back in July of 2020, before the pandemic. I think we were already off to the races coming off of that last death cross, if you will. And then we had the 50-day jumping back up above the 200, which increases, which is indicative of an uptrend. So you had one there, you had another death cross over here where it crossed over. And again, you had a bounce, but then you had more specifically downside. Then it came up, and then you had the downside with the death cross again. So you can look at them any way you want to look at them. It could be a positive uptrend thing with more sell-off coming, or it could be a downtrend action in the market. And if you look, here's one right here where there was a death cross. This is back in 2018, 2019, had the little death cross. We had a little bounce, but then boom, we sold off and we stayed in a downtrend for a while. Again, that's that accumulation phase. And if you think about when the institutions entered the market, there's been institutional traders, professional traders that have been in the market for a while, but institutions themselves have largely entered the market here in the last 1.5 to 2 years, especially with the big moves that we've seen after the March 2020 situation. So if you go back to the last time, basically here was your December 2017 high, and we've been tailing off since then. You got your death cross right here in March of 2018. And again, lagging indicator, a lot of the sell-off had already happened, but then what happens after that death cross? It bounces a little bit right here. If we blow this up a little bit, here's your death cross right there. It's where it happens. March 30th, 2018. We got a little bit more downward action, then it starts bouncing to the upside. And that's a pretty good little bounce. I mean, you're going from 6,500 back up to ultimately about $9,900. So you had almost a 2X there. You had about a 75% bounce. After a 75% decline, you kind of bounced back a little bit. And then you're down from there, ultimately for quite a while. A little bit of sideways action down, sideways action down, sideways action. Then you bounce down again. So a lot of volatility, a lot of instability in Bitcoin through the years. And so you can go back and track those and trace those over time. but I thought that the Wyckoff distribution as it related to gold over the last 10 years and as it currently relates to Bitcoin and how Bitcoin looks now, and this range that we're in here, and how long this could potentially last. And I know a lot of people, a lot of professional traders are saying this could last for a while. We could get ultimately down here soon. There's very little support for the idea that we're going to bounce up long-term from here into a bigger, longer trend. But if we do, again, you got to come up, you got to get above that 59,000 range to get back off to an all-time high again. You have to close above that 59,000. So this could potentially go on for a while before we ultimately get back up to those ranges. And there's a lot of sophisticated individuals out there calling for $100,000, $300,000, $500,000 Bitcoin and beyond. Some people say even $1 million. But it's going to take years to get there, kind of like gold. If you go back to that gold chart and look over the 10-year history, those types of moves don't happen overnight. And I know in Bitcoin's history, we've seen these, huge 20, 30x moves, but that was a very different price point than we're at right now. And ultimately, it could take some time to get there. So we do expect some upward action. The question is how far, how long, and when will it get there? And as we dance around in this range right now, like I said, this is a big liquidity range for institutions. So not a lot of incentive to get out of here anytime soon. So check out the composite band with the Wyckoff distribution. Look at that in relation to gold, how it relates to Bitcoin, and check out that psychology of the markets. I find it fascinating. So I just wanted to bring you that today and just kind of give you something to take a look at. And I hope you enjoy the rest of your weekend.